Ethereum is at a crossroads, not because of price pumps or Twitter narratives, but because the very economic plumbing that once guaranteed ETH's premium is being rewritten by rollups, institutional treasuries, and protocol upgrades. This change can either cement Ethereum as the indispensable settlement layer for a tokenized world, or it can hollow out ETH's ability to capture value while the ecosystem prospers around it. If you want serious, data-driven takes that cut through hype, hit like and subscribe now. Disclaimer. This video is provided solely for educational use, not as financial guidance. All information should be interpreted independently and verified through your own research. Digital assets carry significant volatility and uncertainty. No decisions should be based on this content as investment advice. Treat everything presented here strictly as learning-oriented information. Today, we are going to study line by line the Arkham Intelligence piece titled The State of Ethereum, Digital Oil, L2s, TPS, ETFs, DATs, and I will read the article's claims, then pause only to analyze the implications, contradictions, and practical takeaways you need. I will proceed in the exact order presented: what happened in 2025, performance versus Bitcoin, ETF behavior, the rise of ETH treasury companies, the Tom Lee effect, the digital oil framing, the dynamics of Layer 2s, the technical Fusaka upgrade, and the report's conclusion. In 2025, Ethereum remained the dominant chain by total value locked, holding just over $70 billion in TVL, while its nearest Layer 1 competitors sat in single-digit billions. That raw dominance is not cosmetic. It matters because TVL measures capital actually committed to protocols on the chain: lending, AMMs, derivatives, and more. But the very fact that capital is aggregated on Ethereum has not translated into proportional price appreciation for ETH. The market's valuation has diverged from usage. That divergence forces the central question Arkham raises. If Ethereum is the execution and liquidity hub, why hasn't ETH re-rated to reflect that utility? The obvious first diagnosis is that not all economic value generated on L2s and in DeFi necessarily flows to ETH holders. If transaction fees, MEV, and sequencer revenue are retained off-chain or on L2-specific tokens, the monetization of network activity becomes distributed rather than concentrated in ETH. This distribution undermines the simple narrative that more usage equals higher ETH price, and it demands we look at the actual cash flows in the ecosystem rather than the headline of TVL alone. Arkham then highlights institutional adoption, noting a wave of public companies and treasury allocations into ETH. These digital asset treasuries, or DATs, are buying ETH, and crucially, many are staking it or otherwise using it to generate yield, which in practice increases on-chain staking levels and can improve security. From an economic perspective, corporate treasuries have three effects. First, they create a predictable structural buyer for ETH, which supports baseline demand. Second, staking by treasury entities reduces the circulating liquid float and can create a yield premium that makes ETH more attractive as a corporate reserve. Third, and less often discussed, corporate accumulation, financed through equity markets or convertible debt, introduces a new feedback loop. Public markets can monetize their ETH holdings via traditional mechanisms, which may increase volatility but also deepens institutional integration. However, institutional adoption also raises governance and custodial questions. Who holds these keys? How are staking rewards reported and taxed? And what happens if institutional selling pressure reverses during macro stress? Institutionalization tilts the market toward a narrative of legitimacy, but it also ties ETH to the rhythms of public markets, which can amplify drawdowns even as it broadens the buyer base. On price performance, Arkham documents that ETH underperformed Bitcoin through 2024-2025 despite ETF inflows and the growth of institutional treasuries. This split is instructive. Bitcoin's digital gold pitch is simple and well understood by allocators: a capped supply used as an inflation hedge and store of value. Ethereum's case is more nuanced: settlement, data availability, and modularity. And that nuance costs it in terms of institutional narrative clarity. Market participants buy narratives, and simplicity wins at scale. But that alone is not destiny. The market will price ETH differently if cash flows to it become more predictable. Underperformance therefore signals that the ecosystem has not yet solved the value capture problem. For the active participant, it means betting on ETH appreciation requires conviction in either on-chain flows increasing the burn stake mechanics, or in regulatory and institutional narratives shifting to value ETH more highly. Buying ETH purely because DeFi is large is insufficient. You must see a mechanism that routes revenue or scarcity to ETH holders. Arkham's section on ETF performance is revealing. Ethereum spot ETFs attracted substantial flows, billions over months, but they also experienced large outflows tied to macro and geopolitical events and cumulatively captured a fraction of Bitcoin ETF inflows. ETFs are a double-edged sword. They provide regulated low-friction access, expanding demand, but they also expose ETH to fast institutional capital flows that can reverse quickly. More importantly, ETFs do not change the on-chain fundamentals directly. They create off-chain demand that may or may not align with on-chain monetary flows. So ETF inflows help stabilize and legitimize ETH, but are not a substitute for robust on-chain value accrual. In practical terms, if you're trading around ETFs, you need to watch the macro signals that trigger allocation changes. If you're building exposure for the long term, ETFs are one part of the story, not the whole solution to Ethereum's economic puzzle. The report lists leading ETH treasury companies and portrays their strategic value. Bitmine, led by Tom Lee, SharpLink Gaming, The Ether Machine, ETHZilla, and others accumulating large ETH positions and often staking them to earn yield. These firms act as bridges between traditional capital markets and the Ethereum economy. Their mechanisms, raising capital in public markets and converting it into ETH, create a more persistent bid than retail flows. But there is nuance. The source of their funding, hedging strategies, and how they monetize positions matter. If a treasury funds ETH purchases by share issuance, it dilutes equity holders as it acquires ETH. If it uses options and leverage, it introduces tail risk. For builders and airdrop hunters, these treasury companies are also potential sources of on-chain activity, partnerships, and concentrated liquidity events. For macro observers, they represent a structural buyer class whose behavior will shape volatility and narrative cycles. The key takeaway is that DATs increase institutional presence, but also layer new complexities, legal, accounting, and liquidity dynamics into ETH markets.
Arkham singles out Tom Lee's role at Bitmine as transformational for investor sentiment. Lee's public advocacy, aggressive accumulation, and use of derivatives to increase exposure have been likened to the Michael Saylor playbook for Bitcoin. The behavioral impact of a vocal institutional champion cannot be ignored. It primes other allocators, it creates media narratives, and it converts complex thesis points into investable stories. But there's a risk. Concentrated narrative-driven flows can create an illusion of durable demand that collapses if the narrative shifts. For traders, watching headline accumulation is useful for momentum. For allocators, it is important to separate charisma from cash flow. Does Lee's activity change the on-chain capture mechanics, or does it only move price in the short term? Often the latter. The structural multi-year re-rating Lee promises requires genuine changes to how rollups and the base layer align economic incentives, not only public treasury purchases. Moving to the digital oil narrative, Arkham restates that ETH functions as the fuel of the ecosystem. Gas burned with activity, scarce supply pressures via IEP 1559, and utility across contracts and rollups. That metaphor is powerful because it links usage directly to token economics. More activity consumes ETH and increases scarcity via burns. But the metaphor is incomplete because oil in the modern economy is priced through global markets and produces rents that are often captured by different stakeholders: producers, refiners, pipeline owners, and consumers. Similarly, Ethereum's modular architecture creates new middlemen: sequencers, roll-up DA markets, and MEV extractors. If those entities capture the rents, ETH becomes more like land under which cities are built, essential but under-monetized. The policy implication is clear. To preserve ETH's monetary premium, protocol designers and rollups must build alignment primitives that route sufficient economic value back to ETH holders. Burns, fee sharing, cross-rollup settlement mechanisms, or other instruments that reunite activity with token economics. Without such mechanisms, the digital oil story risks turning into a technical description that fails to explain who actually profits. Arkham's coverage of Layer 2s emphasizes the explosive growth of rollups: Arbitrum, Optimism, Base, ZK Sync, Starknet, and others. These L2s have become the workhorses of execution: cheaper transactions, higher throughput, and differentiated UX that draw mainstream users. IEP 4844 blobs, introduced by the Dencun upgrade, reduced data posting costs and unlocked more efficient rollup economics. But the critical economic tension is allocation of fees and MEV. Sequencer operators and L2 token models can internalize large swaths of revenue. If the economic surplus remains primarily on rollups, ETH's claim on value weakens. The counterargument is that without L2s, Ethereum could not scale, and therefore the pie available to capture would be much smaller. From a systems perspective, the right metric is not only growth in transactions, but also the fraction of surplus that accrues to ETH. Practically, that means monitoring sequencer fee models, MEV extraction patterns, and any L2 designs that commit to revenue sharing with the base layer. Where rollups voluntarily or structurally align with ETH via periodic settlements, burns, or tokenomics that favor ETH, the digital oil thesis strengthens. Where they internalize returns, ETH becomes a neutral settlement layer with less upside for holders. Arkham then drills into MEV and sequencer economics. MEV has migrated heavily to L2s, manifesting as arbitrage opportunities, liquidations, and reorderings. On L2s that retain sequencer revenue, this creates a powerful incentive to keep value off the base layer. The practical implication is twofold. First, from a regulatory and ethical standpoint, concentrated MEV extraction can centralize power in sequencers, which threatens decentralization. Second, from an investment angle, MEV that does not feed ETH holders weakens the token's revenue case. This is not a one-sided argument. Some rollups are experimenting with revenue sharing, decentralized sequencers, and mechanisms to curb harmful MEV. These experiments matter more than ever because protocol-level choices made now will determine where future economic rents accumulate. For strategists, tracking which rollups commit to base layer alignment is as important as tracking TVL. The article's technical deep dive centers on Fusaka, scheduled for December 3, 2025. Fusaka bundles multiple substantive improvements: pure DOS to reduce node storage and bandwidth requirements, blob parameter increases via BPO forks to expand DA capacity, a higher default gas limit to allow more on-chain execution, Verkle trees for efficient state commitments and light clients, and EVM optimizations including SecP 256R1 support and a CLZ OPC. The net effect: lower node running costs, greater data availability on the base layer, and more headroom for rollup operations. From a systems design view, Fusaka is not merely performance tuning. It institutionalizes modularity by making the L1 a vastly cheaper and more practical DA plane. That increases throughput for L2s and lowers user fees, which is great for onboarding and product innovation. But it also accelerates the very dynamic that threatens ETH's capture unless paired with alignment mechanisms. In short, Fusaka expands capacity and cuts costs, which is fantastic for user growth. Whether ETH benefits depends on the economic contracts that link rollups to the base layer. The reports also highlight specific Fusaka features with direct economic consequences. Pure DOS reduces barriers to entry for validators and light clients, which should enhance decentralization and resiliency. Raising blob capacity via BPO forks lowers marginal costs for DA, making rollup economics more predictable and enabling high-throughput applications. Think microtransactions, IoT telemetry, or mass tokenization of assets. Verkle trees will shrink proofs and make light clients viable at scale, which is a structural improvement for permissionless participation. Each of these technical moves increases demand for posting data, but the core question returns: who captures the economic benefit of that demand? If base layer fee sinks, burns, or staking-linked revenue sharing are strengthened, ETH benefits. If rollups capture the surplus via sequencer fees, the base layer's monetary case remains fragile. Architects and governance actors, therefore, must pair technical scaling with tokenomic alignment. Arkham's conclusion is sober. Ethereum sits at a pivot point. Its developer mindshare, network effects, and DeFi depth are real and durable. But the ecosystem faces a choice about alignment.
If rollups and the base layer coordinate to route sufficient economic surplus to ETH via burns, direct fee mechanisms, or coordinated revenue sharing, then the digital oil thesis is reinforced, and ETH can re-earn a valuation multiple more aligned with its usage. If not, Ethereum may become the indispensable settlement rail whose native token is undermonetized relative to the value it enables. Practically, watch three vectors: how rollups design sequencer economics, how Fusaka's increased capacity affects on-chain burns and blob fees, and how institutional treasuries deploy and report their ETH holdings. Those three will determine whether usage translates to price. To close this continuous analysis, here are the immediate tactical takeaways embedded in Arkham's assessment. Prioritize attention on rollups that commit to alignment and revenue sharing. Monitor on-chain flows, burn rates, blob fee accruals, and staking participation rather than surface metrics like TVL alone. Follow institutional treasury filings to gauge durable demand. And treat protocol upgrades like Fusaka as catalysts that change supply-demand mechanics rather than as purely technical events. That completes our step-by-step reading and analysis of Arkham's The State of Ethereum, Digital Oil, L2s, TPS, ETFs, and DATs.